Okay, I think we'll get started, and thank you all very much for joining us this morning. My name is Steve McMenamin. I'm your host for today's event, which is part of the continuing series of the Greenwich Roundtable. Our topic this morning, Pure Passive, the Risks and Rewards, is our first act of heresy in the Temple of Active Management. For the last 22 years, we've listened to hundreds of hedge funds and buyout managers describe scores of exotic strategies. Today, our speakers are here to tell why our pursuit of skill and our quest for connoisseurship has been folly. So some of us have been working the alternatives field while we've been privately indexing. Before I introduce our speakers, I'll quote Peter Bernstein speaking from this room 10 years ago. Everyone thinks they can beat the market, but being average is actually quite an accomplishment. And as always, the speakers' views are their own. So, starting to Bob's left, Charlie Ellis may need no introduction for those of us in the room, and he's been pounding the table on indexing since Metro North enacted peak fares going to New York City. He served in governance roles and chairs some of the leading investment committees such as Yale, Phillips Exeter, the Futures Fund, and the GIC. He's written 17 books, and his most recent, The Indexing Revolution, is in the rotunda on your way out. Sitting to Charlie's left, Colin Kerwin is the global pension fund manager for the ExxonMobil Corporation in Irving, Texas, where he's responsible for overseeing $30 billion in retirement assets held in over 25 countries. Mr. Kerwin is recognized for being a strong advocate of defined benefit plans and for the economic benefits of de-risking strategies. Recently, Chief Investment Officer magazine named Colin one of the 100 most influential global investors. He's been with Exxon for 34 years. And sitting to Colin's left, Jim Rowley is a senior analyst in Vanguard's investment strategy group, where he leads the team that conducts research and provides thought leadership on issues and on indexing and other kinds of related issues. Before joining Vanguard 10 years ago, Jim worked at Gartmore Investments, Lehman Brothers, and Merrill Lynch. He is also the past president of the CFA Society in Philadelphia. And finally, Bob Dannhauser is the moderator of the Greenwich Roundtable today. Bob is the head of global private wealth management at the CFA Institute in New York City. Bob manages a team of analysts investigating the frontier of wealth management for private investors. And before that, he produced thought leadership content related to the integrity of the global capital markets for the CFA Institute. And so please welcome Bob as he sets the table for us today.
Thanks, Steve. Dobroye utro, tovaryshi. Now, if my Russian colleague hasn't led me horribly astray, what I just said was good morning, comrades, in Russian. And I start that way because there was a very interesting piece of research that came out of Bernstein a couple of months ago that had the tantalizing title, The Silent Road to Serfdom, Why Passive Investing is Worse Than Marxism. They really know how to sell research there. And it began what's been a groundswell of public commentary and media attention to the phenomena of massive inflows into passive investing. And it's not that it's just being recognized in these last couple of months, but it's reached such remarkable scale that it seems worthy of commentary and indeed worthy of conversations like this this morning. We're not going to spend our time this morning in the classical active versus passive debate, although I think certain elements of that are likely to come up in our panelists' remarks. But rather, we'd like to talk about why people are where they are and what perhaps some of the unintended consequences, risks, and opportunities are for folks who are in the passive space. There's a number of dimensions that we can consider, and I hope that our panelists will touch upon not only what it means to individual portfolios and investment objectives and risk budgets, but also the larger sense. Systemically, are there risks being posed by this groundswell of assets flowing into passive? What indeed are the implications for our capital markets? The Wall Street Journal did a series a week or two ago about the do-nothing investors, including a subsequent profile of some poor individual in Nevada who is profiled as running a $35 billion state of Nevada investment fund, but not doing too much because really all he's doing is overseeing a passive fund. And gosh, that seems really easy. You don't really need to do much to do that. That's probably not the case. But one of the most fascinating statistics that I picked out of the Wall Street Journal coverage was the idea that in 2005, just 2 S&P 500 companies were held in passive and ETF mutual funds that pursued passive strategies that were held by collectively at least 10%. So 10% of the shares outstanding held by those vehicles, just 2 companies. In 2016, it's 458 companies in the S&P 500. So there's implications for corporate governance and perhaps at the extreme even for price discovery in the marketplace. So without further ado, I'm going to turn it over to Charlie, who's written a book about revolution. I knew that the Russians had infiltrated our electoral process. I didn't know that they had extended their influence to the capital markets. And since we couldn't get Karl Marx to join us this morning, we're going to have to settle for Charlie Ellis.
Das Vidania. There's nothing communistic and nothing Russian about indexing. The big risk on passive is very obvious. How the hell would you like to be introduced by your children, your spouse, or your parents as, this is my son Charlie, my dad, he's passive? It's a pejorative. And anybody that gets stuck with that pejorative has got a real problem. If we switch over to index, all that negative atmosphere goes away. I'd like to remind you of what it was like some time ago, just to put things clarity. When I came out of Harvard Business School in 1963, there were no courses taught in investment management at that school. There was a course on trust administration called Darkness at Noon because it started at 11:30 and went to 1 o'clock and had an extraordinarily boring professor. Trading on the New York Stock Exchange was 90% done by individuals who, on average, bought or sold a stock every year and a half, and about half of their purchases and sales were AT&T. They had nothing to do with inside the market. They bought because they got a bonus or an inheritance, and they sold because their kids were going off to college or that they wanted to buy a home. There was no performance measurement. 40 cents a share was about normal. There were no CFAs, damn few MBAs. I know because I was one of the 2 of my class that came to the investment management world. And you only went into the business if you had a family fortune that you were going to take responsibility for. It did not pay well. Today, 99% of trading is done by experts, professionals. 50% of all trading is done by the 50 largest, most active. The trading volume has gone from 4 million to about 5 billion. There's 125,000 CFAs, and there are 200,000 CFAs in candidacy. First largest group is North America, then India, then China. Mike Bloomberg was still trying to get a job at Salomon Brothers. There are now 320,000 of Mike's machines out. They really work pretty darn well. And if you think how many people does it have to justify a machine, Bloomberg, it's probably something like 3. So multiply 3 times 320,000 and you come pretty close to 1 million people are involved in active investment management. Way back in 1963, I can assure you there were not as many as 5,000 who were so involved. So I believe that you could make a simple summary that there's been one hell of a change in the nature of the markets that we live in and the way in which we do our work. I'd like to talk a little bit about the rewards of indexing. Notice I do not say the rewards of passive. First, other people do all the work. And there's a certain satisfaction that goes with having other people doing all the work. They also cover virtually all the costs of keeping the market as efficient as it is, as smooth operating as it is. You can buy and sell damn near anything you want to, pretty confident that the price is about right. So you don't have to be capable. You can just be there playing along, buying and selling a little bit. And all you have to do is be able to articulate a reasonable case that the results that you're able to report to your clients actually are statistically of some significance. Anybody who studied statistics would know that investing is a long-term, continuous process with so many different variables and so much complexity that there is no way that you could determine through evaluations of the data that we see in most meetings in less than 50 years. Bar Rosenberg, who made the most careful calculation, came up with 74 years. But it's a long, long term. Most of us are able to get by with 3 years, and therefore we ought to be able to find some period of time when we can go out on the sales circuit. And once we've been out on the sales circuit and done well, we can keep the clients by being good, kind, cheerful, thrifty, clean, brave, reverent, and in other ways looking like the right kind of person. If you're in indexing, you don't have to, taxes are an important concern for people who are in active investing, particularly for wealthy individuals, and they take all the risks. So if you're in indexing, you can really skip all the things that drive most everybody else crazy. What you also can do is, for the first time in your career or your life as an investor, take all the time you want to answer those really, really important questions as an investor. Who are you? And what makes you different from other people? And what are you trying to accomplish? What are you trying to avoid? And almost every one of us in this room spends almost all of our time with people who haven't yet gotten around to having the time to think deeply about what are they trying to accomplish. And as a result, they do not have the kind of a portfolio structure that they could have, which would make one terrific positive difference. There's some risks. Number one is that you probably wouldn't get interested in smart beta, although I do think it's a marvelous term. The risk to your business is formidable, because if people turn to indexing in a substantially larger way, and it sure looks like they're headed in that way, many of the things we've learned to be used to, lovely homes, lovely settings, lovely children, all kinds of really interesting things, will be under some sort of pressure. Maybe that's all right, because it won't be us, it'll be the succeeding generation. That's my own personal hope, but I think we have to recognize that. The last is really the most serious, and that is the psychological or social disadvantage of being known as passive. Nobody has anything positive to say about being passive, whether you're passive in investing or in any other line of work. And I don't want to be passive under any circumstances. So I'm going to use the word index, and I would invite all of you to do the same. One last thing. If you do go to indexing, you will never become famous for having beaten the market. And you will never win the gold medal or be in the front pages of pensions and investment news or some of the other things that we kind of think might be kind of fun here and there. I think you can live without it. That's the end of my 13 minutes.
Thank you, Charlie. And while it's true that you may never make the headlines for beating the market as a index fund investor, I'll adhere to your paradigm of not calling them passive investors.
Thank you.
It's possible, indeed, to be a bad investor in index funds. And our other panelists, I'm sure, are going to touch upon the idea of the differentiation between passive investment products and passive investors, and indeed how the combination is important.
Bob, if I could, I'd just like you all to understand the logistics. I was on I-95 waiting. These wonderful guys had a terrific dinner, and they decided what our order of speaking would be.
Charlie lost. Colin, we'll turn to you. You have the interesting position of running one of the largest corporate pension funds and have taken a strategy that deviates a bit from your peers.
Just a bit. Yeah, we're not actually one of the largest corporate pension funds, despite the size of our company. If you think about ExxonMobil's business, we're primarily a capital-intensive business, not a people-intensive business. So while we have $30 billion of pension assets around the world backstopping the promises we've made to our employees, it's a relatively small number in the scheme of some corporate pension plans around the world. And it's also a relatively small number relative to the size of our total balance sheet, unlike some companies. So I'm going to talk about some of the basic principles about what drives us to be passive investors at ExxonMobil, some of the benefits that we receive from that, which we believe are quite significant. And then I'm going to end with a few remarks on maybe a little bit of investing theory apart from this active-passive debate, to give you some insight into how we think about our portfolios and why we are so different than many of our peers in managing corporate defined benefit plans. Our plans are still open all around the world. New hires to ExxonMobil get a defined benefit. We do not think they are difficult to manage, nor are they particularly costly. So we are very different. I'll start with some basic principles on passive investing, and I feel awkward sitting next to Charlie because he basically talked about this 3 or 4 decades ago. But market risk is rewarded, right? Otherwise known as beta risk. This is a risk that you cannot diversify away, so it makes sense that it should be rewarded by the marketplace. Active risk, on the other hand, certainly the weighted average returns from active risk, otherwise known as alpha, or pure idiosyncratic risk, is not rewarded. Because you can diversify idiosyncratic risk, it is not rewarded by the markets. So what this means is that active management, at best, is a zero-sum game, by definition. Doesn't mean that there aren't skilled investors that can beat the markets, but on average, across all active investors, by definition, it has to be a zero-sum game. All active investors are not from Lake Wobegon, as much as they would like to believe that they are. One's gain is another's loss, a zero-sum. Now, Charlie talked about a loser's game back in 1975, I believe, in an article you published with that title. And he's basically arguing that it's not just a zero-sum game, but it's a loser's game. It's a negative game. Higher costs involved in active management mean that on average active investors as a whole must earn less than passive investors. The higher fee drag from investment management fees, transaction fees, taxes if you're a taxable investor, with all the trading that you're doing, eat into the available market returns. At the same time, there's been, as Charlie just talked about, tremendous increasing skill and competition among active investors. The market has become principally comprised of institutional investors, all with tremendous resources and skill. So the game has gotten even harder to play. So it's that much more difficult to consistently outperform the markets in today's environment. The conditions for success have very long odds if you're trying to play that loser's game. 4 things must all be true. 1, you must identify an inefficient market. That's a necessary condition for active management to work, but it's not a sufficient condition. 2, you must identify ex ante, beforehand, a skilled manager. That, too, is very, very difficult. 3, you have to believe that that skilled investor has an advantage that is going to be persistent through time. It's the expected forward alpha that counts, not how the skilled investor has performed in the past. And 4, you have to believe that the skilled manager is willing to share their particular skill set with you, net of the fees they're going to ask for. So all 4 of those things have to be true in order for you as an investor in an active strategy to benefit at the end. It's clear that the manager is going to benefit from the fees that they're going to collect, but is the end investor going to benefit? And I think that's how Charlie so eloquently described this as a loser's game so many years ago. When you look at the empirical data, it suggests also that it is extremely challenging to beat passive benchmarks. S&P publishes their SPIVA benchmarks, which make it very clear that very few active managers can consistently beat passive benchmarks. The Wall Street Journal series that was mentioned earlier has been looking into this issue over the past few weeks. Our own experience at ExxonMobil, we used to invest in enhanced and active investment strategies in our defined benefit plans around the world. And we ultimately found that we were not beating passive benchmarks net of fees. So in 2008, 2009, sort of unrelated to the financial crisis, we made a very big decision to basically fire all of those enhanced and active managers and move entirely to a passive investment environment. And I'll say more about that in a moment. I've been in my current position for 13 years managing our global pension retirement assets. I've been, as Steve said, in the business for 34 years. Over those 13 years, I have received literally thousands of calls and emails from investment managers who want a piece of our $30 billion. Every day, I get calls and emails. It's not surprising. Never once in those 13 years has an active manager come to me and shown me historical results that don't beat the passive benchmarks. Everyone is from Lake Wobegon that comes to talk to me. Something's wrong with that picture. That all cannot be true. Another perspective we have, beyond just thinking of it as a loser's game and very difficult to win at that particular loser's game, is that at the portfolio level, it introduces even more challenges. Maybe you can find a single skilled investor that's going to outperform the markets. Maybe you can find a handful of skilled investors that are going to outperform the market. But if you're building a portfolio of active investors across $30 billion of assets, and each one of those skilled managers doesn't see into the portfolios of all the other skilled managers you have in that portfolio, it's quite likely by the time you complete it, one's particular position is offsetting another's particular position, and you end up essentially owning the market while paying extremely high fees. Why not just own the market passively and pay extremely low fees? So I think it's a very big challenge to develop a large portfolio of active managers and not have that sort of canceling out effect that's going on, because they're not looking at each other's portfolios, and they don't want to let people look at their portfolios. And if you are building a large portfolio of skilled managers, you by definition have to have many managers, right? Because you have manager risk. In a passive portfolio, you're invested in a commodity product. You do not have manager risk. So you can aggregate quite a large number of assets with a single manager. In an active strategy, you can't do that. You have to have many, many managers, which adds complexity to the overall portfolio as well. Let me talk briefly about the benefits that we get from passive investing over and above the savings that we achieve on investment management fees. And I just alluded to this point, that one does not need tens or even hundreds of investment managers because you have little or no manager risk. Before we made the decision to go passive, we had managers in U.S. large cap, U.S. small cap, international large cap, international small cap, emerging markets, private equity. And within each of those asset classes, we had more than one manager. Today, across the global public equity market, both developed and emerging markets, 46 countries, 8,600 stocks, we have one manager. And it's BlackRock, and I know some of the BlackRock people are here today. They won that competitive bid in 2009. We virtually aggregated billions of dollars of our assets from our pension plans around the world into a single MSCI ACWI strategy, which was kind of new at the time. 4 different competitors bid for that business, and BlackRock won it. And it's been tremendously administratively savings for us, because no longer do I have to control and monitor many, many different managers with all of the risks inherent in that. The process has become very, very simple. Another less obvious savings is the elimination of a lot of unnecessary asset allocation studies. So when we used to have those different buckets within the public equity universe, my group would conduct asset allocation studies. We'd develop return assumptions, standard deviation, correlation assumptions for each of those different asset classes. We'd throw it into a mean variance analysis. We'd layer in all sorts of management constraints so the model wouldn't spit out and say we should have 100% in private equity. And by the time we got to the end, effectively, I believe we had garbage in, garbage out. We were placing bets implicitly or explicitly against the market. And we don't need to do any of that anymore. We simply own the market at the market cap. And so as stocks migrate from small cap to large cap, from emerging to developed, or vice versa, we don't have to buy and sell. Our managers don't have to buy and sell. We just own it. It's essentially as close to a buy and hold strategy as you can get, owning the entire market in one single strategy. Maybe an even less obvious and perhaps, covered this point. So those are some of the very large benefits we get beyond fee savings. Administrative overhead, greatly simplified. The burden of controlling and monitoring many, many different managers, all those manager visits, hiring and firing, it's gone away. Asset allocation studies, gone away. Tremendous efficiencies that we've gained. I want to end, and I alluded to this, with talking about a little bit why we think about pension plan management differently than others. And at its core, and it gets to the point we heard earlier from Charlie about why are you managing this portfolio? What is its purpose? Defined benefits, when you cut through it, is a loan. The employee is making a loan to his or her employer during their working career. The proceeds of that loan are the lower cash salaries that we're paying the employee in return for offering them this defined benefit. And we've promised to repay the employee when they retire with interest in the form of a lifelong annuity. So the employees are lenders. The company, the plan sponsor, is the borrower. The lender owns a very undiversifiable portfolio. It's going to be a big chunk of these individuals' net worth. They cannot diversify it away. It's with one single company, in our case, ExxonMobil. So through their elected officials in 1975, they had ERISA passed and required plan sponsors to set aside assets as collateral in bankruptcy-proof trusts to ensure that if we were to go bankrupt, the assets will be there to satisfy those obligations. When the person retires, their human capital has been exhausted. It would be a tragedy, a travesty, if the assets weren't there to pay them what they were owed. So for good public policy reasons, we are required to set aside assets, $30 billion in our case, in separate legal trusts to protect these benefits. The point is this portfolio serves as collateral. It was never intended to pay for the benefit. It was intended to protect the benefit. So when you look across pension plans across corporate America, both private and public, most of them are invested in risky assets. They're trying to grow the portfolio to pay for the benefit, not to protect the benefit. They're not managing those assets as collateral as they should be. So that's point number one. Point number two is you have to think about who has the economic benefits and burdens of ownership of those pension assets. Is it the plan participants, or is it the plan sponsor and its shareholders, or if you're in the public sector, the taxpayer? And the answer to that question reveals itself in the defined benefit formula itself. A defined benefit formula in a traditional final salary plan is years of service times final salary, some definition of final salary, and a fixed multiplier. In the case of ExxonMobil's U.S. plan, I'm entitled to 1.6 times my years of service times my final salary. If I retire tomorrow, I'm going to collect approximately 50% of my current salary for the rest of my life and my wife's life. It's a very attractive retirement benefit. And in an environment when interest rates are close to zero, I'm guaranteed income for the next 30 or 40 years of my life. So a very attractive product. But nowhere in that formula are the asset returns or losses from the pension assets. Curious. It's a defined benefit. It's fixed. So the party that has all the economic benefits and burdens of the assets is not the plan participant. It's the plan sponsor and its shareholders. Okay? Very important point. Even the SEC recognizes this. So what that means is the pension plan, like the corporation, is simply a pass-through vehicle. It's a conduit vehicle. We don't hold any risks at the end of the day. The pension plan doesn't hold any risks at the end of the day. The company doesn't hold any risks at the end of the day. It's our end shareholders, the true investors in ExxonMobil, that hold the risks. And Markowitz's modern portfolio theory of building diversified portfolios, and he said it himself, only works at the end investor level. It does not work for pass-through entities. So the $30 billion I'm charged with managing, it's impossible for me to build an optimal portfolio because I'm serving millions of different shareholders, each with their own utility preference, each with their own particular net worth, each with their own particular asset profile, and I don't know what that is. And the only way to build an optimal portfolio is to look at an individual's entire portfolio. If you're just looking at a piece of it, you can pretend you're optimizing that piece, but it may be counterbalancing the rest of the portfolio. So when you recognize a corporation and a pension plan as a pass-through vehicle, you cannot apply the techniques that most of corporate America applies to the management of pension plans. It just doesn't work. So in our case, what we're doing is managing the assets as collateral against the long-term liabilities we've promised, which are effectively long-term debt, a lot of interest rate characteristic duration. So we're building long-duration fixed income portfolios to, in effect, immunize those liabilities and choose instead to take our risk outside the pension plan in our core business, which is where our shareholders expect us to be taking risk in profitable oil and gas opportunities around the world that they cannot do by themselves. So I'll stop there.
Colin, thank you very much. Very interesting. We'll next hear from Jim Rowley from Vanguard, and Vanguard is, of course, synonymous with passive investing, and so you probably think you know what you're going to hear from Jim, but based on our conversation last night, I think you might be surprised. Jim?
I'm going to rally the cause for active management. Leave it to the Vanguard guy. And I say that seriously because having been at Vanguard for the past 10 years and heavily involved with our ETF business and our index fund business, it's become quite evident that the most unheralded reason for the popularity of ETFs is they make great tools for managing active portfolios. When we think about the metrics and the statistics about the percent of cash flow and or assets that go into indexing, I won't say passive, Charlie, that go into indexing, it's important to recognize, can we please define that term? Right, that dollar goes into index funds, it goes into the individual pieces, but that dollar does not go into a total stock market index fund. So what ends up happening is investors have decided that these individual index fund pieces can then be aggregated up for various strategies. Right, so the one way we look at this definition of indexing is a strategy that we refer to as active indexing. Or my boss likes to say, are you being actively passive or passively active? Right, the idea is I can put together pieces of market cap weighted index funds in an effort to add value or beat the total market through betas or systematic exposures rather than trying to beat the market by security selection. My advantages to that are style purity. By multiple index providers' definitions, you could use Russell or S&P or CRSP or FTSE or whoever's definition of certain market factors you want to follow. You can do that very well with a control and a style purity factor that you can't get from security selection alpha. And you can do that by U.S. style box. You could do that by developed versus emerging. You can do that by treasury bond versus corporate bond. All of your pieces, all in told, could hold the total market. It's just not weighted by the total market. And you can do this with a high degree of cost effectiveness. Right? There are many ETFs out there. If I wanted to buy somebody's version of a total stock market index, I can get that for a single-digit basis point cost per year. I could probably also get somebody else's ETF that is a total value index fund or a total small cap fund or a mid cap growth fund, whatever you think your other systematic exposure is that is the most attractively valued for you to beat the market. But I can probably buy that product in a teens, 13, 14, 15 basis points. So with two products, I can put on my tilt of choice for a weighted average expense ratio of 10, 12. If we think about one of the main hurdles of outperforming is cost, and I can take two products that comprehensively cover the total U.S. market, so I still get my broad diversification, I still get my low cost. I put these two products together at an extremely low cost, and I'm giving myself an opportunity to outperform by putting on a tilt. That's a very attractive value proposition for active management. The difference here is it's not about security selection to beat the market. The difference is it's about systematic exposure selection. to beat the market. And with just a handful of funds across equities and fixed income, I can have a very broadly diversified portfolio, and I can pick and choose my tilts along the way. So that's issue number one, is realizing that that dollar that goes into index funds, it's not going into the total market. It's going into pieces that in aggregate are building active strategies. That's sort of number one. Number two, Charlie alluded to this. That definition of index fund, according to the SEC and legally speaking, includes many of these smart beta / rules-based / factor-based funds, that the strategies or the indexes themselves that are constructed are not market cap weighted. And the argument aside of do we like it, do we not like it, the fact is market cap weighting is the market. And the choice to weight something differently than market cap is an active decision. And I say that in a non-pejorative manner. That's not negative. That doesn't make it bad. It just means it's an active strategy. You have providers that are able to get into the game through what is a business distribution channel through these smart beta funds. Again, legally, technically, they count as index funds. So as a result, again, going back to the metrics and statistics of see the amount of cash flow and assets in index funds, number one, not only does this include assets in these pieces of market cap weighted funds that in aggregate are building active portfolios, but number two, it includes these products that are gaining substantial market share that are smart beta, which are also active products, despite the SEC's legal definition. And if you wanted some proof in the pudding type of statement to this, I had my team back at work say, can you go find me or build me, if you want to call it the dollar-weighted portfolio of all ETFs in the U.S. that track some type of U.S. equities mandate, and give me a sense of the active risk to help prove this point. And all the other facts and figures aside, I can tell you that aggregate portfolio from an active risk perspective is about 13 percentage points underweight the largest decile of stocks in the U.S. It's about 5 percentage points overweight decile number 2. Yada, 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 all the way down 3 through 10. But the idea is, if I put together this notion of the pieces going into these index funds and the altered definition of index to include non-market cap weighted strategies, we are now getting a portfolio of index funds and ETFs that is not weighted as the total market. So I tend to give that flows into passive a little bit of an asterisk that goes with that. So in the spirit of risks that go along with this, I had thought about this and jotted down 3. We get our share of urban legends and declarations of risk caused by this phenomena into passive/indexing. And I always seem to come up with this idea of, well, there's a perceived notion of what the risk is, but then there's the real idea of what the risk is. And that's not to say the risks aren't real, but it is to say the risks should be viewed in their proper perspective. So risk number 1 I hear about all the time is these flows into passive are distorting the market. I've heard everything from it causes higher to lower correlations, higher or lower amounts of market volatility, higher or lower amounts of market dispersion. If I drew you a chart that showed the percent of flows into long-term passive funds, it would be a 45-degree straight line for the past 15 years. Clear as day trend. But if I superimpose market volatility, it randomly fluctuates. If I showed you pairwise correlations of stocks, it would randomly fluctuate. If I showed you dispersion amongst stocks, in some cases it would randomly fluctuate, or by some other measures it would be a consistent trend. If I threw in the percentage of top 10 stocks in the US, flatlined. So I've heard both sides that it causes yay or nay of all those, and all I can tell you is looking at the piece of paper, there is no trend. That's the perceived risk. The real risk is, well, that's what happens in the market. Correlations go up and down, dispersion goes up and down, volatilities go up and down. So we need to take the focus away from index funds and ETFs are causing this to, like we're all used to, that's just kind of how the market works. So that's perceived versus actual, number 1. Number 2 is I hear the claim, well, Jim, what do you think about the structure of ETFs? Is there something flawed with their structure? Over 90% of the assets in ETFs are in those that are structured as 40 Act funds, meaning they're mutual funds. So if we have issues with the structure around ETFs, I always say let's point our finger and start asking questions about the structure of mutual funds, because from a DNA standpoint, they are overwhelmingly the same thing. Your two main differences, or the differences between ETFs and mutual funds, really come down to two things. You transact with another investor on an exchange, meaning you don't have a redeemable security that you transact with the fund. And number two, you trade at an intraday market price. You do not get the next available NAV. So again, this perception of, well, the structure of ETFs make them riskier, I say, well, they're really more like mutual funds than anything else. As a matter of fact, they are far more similar to mutual funds than they are dissimilar. Your actual risks come down to the same old type of due diligence that everybody in this room would be doing when looking at active management, which is what's the strategy of that index fund and how is it implemented? And that's a good old-fashioned tire kicking that you would apply to active, you would apply to indexing. You might ask a slightly different set of questions, but it's the same type of due diligence because the structure is the same. Third risk I hear all the time, and again, it's a perception risk, that in times of market stress, the liquidity of ETFs dies up, goes away. So there's something wrong with them. The phrase I like to use is that ETFs are just another organism in the ecosystem of capital markets. So whether or not somebody wishes to pick the flash crash or the date of August 24th, I would tell you that the issue around stub quotes and up limit, down limit are rules that are applicable to everything traded on an exchange. So whether or not you have a single stock or an ETF, again, they are organisms in an ecosystem subject to the rules put out by exchanges. So that is not a case of ETFs causing anything. That is a case of ETFs reacting to the rules of the game. That's the perceived risk, that somehow they're causing that. What I would tell investors is the actual risk is, and sometimes this gets, I'll say a lot of times, this gets glossed over by some of our competitors in this industry. As an investor, unlike mutual funds where you put an entry in and you hit go and you get next day NAV, with ETFs, you are responsible for your own execution. It's all warm and fuzzy and rainbows and unicorns to tell people, oh, these ETFs are great, look at this, and you get intraday trading. Well, with intraday trading comes the responsibility of your execution. And it's very important that you treat it as such. And we have a long list of best practices and guides that I share with investors. The two that really come to mind are, number one, use limit orders, or the phrase we sometimes use, marketable limit orders, is a great best practice when transacting in ETFs. And the other one is use a block desk. The liquidity that you see on the screen for an ETF is not its true liquidity. ETF liquidity is a function of, yes, the average daily trading volume of that ETF. It is a traded entity, but also the liquidity of the underlyings. Because ETFs are far more like mutual funds, meaning they are open-ended funds, there are additional venues of liquidity that can be tapped by the market-making community that you do not see on screen. So just because you see something that, I'm making up numbers, trades $1 million a day and maybe only has size at 300 shares each on the offer and the bid, if it's a fund that tracks, let's say, very large cap stocks, your block desk has access to other sources of liquidity that go well beyond what you see on the screen. So again, if I were to wrap that all up, right, this whole notion of the definition of indexing and or passive has benefited really because they make great tools for use in active strategies. And then the concept of risks that we see, I always think to myself, is that risk a perception? Is that the real risk? Or do we need to make sure that we're turning our attention and putting those risks into the proper perspective?
Thank you, Jim, and thank you all. We're going to turn to your questions in just a minute. I wanted to ask the panel, though, there's a common refrain from the active management community that says, look, we're good CFA analysts. We've been trained to look at the fundamentals of security valuation, and we kind of like the fact that there's valuation insensitive money pouring into index products. But is there a tipping point? Is there a point where that that index fund investment overwhelms fundamentals such that active managers just can't do what they've been trained to do?
Sure. The answer is yes. Very definitely a tipping point. Might be single-digit number. If you say, look, we're roughly a third index now, convert that over to trading activity, and it's a tiny, tiny fraction. At what point do you get to the stage where so many people have withdrawn from active investing because it doesn't work for them, it doesn't make sense for them, that now, by God, it's really attractive to get in, and let's go do it. I'd encourage you to take a look at the incidence of smoking in this country. It's pretty clearly evident that smoking has a very high probability of causing cancer. Cancer has a very, very high probability of causing death. The pictures that you can get are awful, just awful. But there's still a considerable amount of smoking going on. I like Las Vegas because it just doesn't make any sense to me at all. And I talked to my family about it. I said, don't do that. This is crazy. Don't worry about it. We've all set a limit. What do you mean you set a limit? We're all decided how much we're going to lose, and then we're going to go play, have a nice time. And as long as they've got a limit that they'll stick with, I'm okay for them to go and lose it. But there are people who gamble on a regular basis, and they're going to keep it up. And people do all kinds of screwball things, and they're going to keep it up. And there are people who are in sufficient level of denial of the overwhelming evidence that they'll never get anywhere near the stage where it really does make sense to become an active investor again in terms of the interests of the client. We have to keep that separate, in all fairness, from the interests of the agent of the client, because, as we all know, the highest paid line of work in the world is active investing. And that's one of the reasons that we're so interested. Another reason is because it's so damn interesting as an activity. Another is because we've all got competitive natures and we want to see if we couldn't do it ourselves. And there's a wonderful, wonderful values. But if you took away all the compensation and took it back to what it was like in the late 50s, early 60s, I think a fairly large fraction of people who were involved would withdraw. That level of change is a long, long way off. And that's why I figure somewhere around 90, 80, in there somewhat percent of assets being converted to indexing would be where you'd start to see some real cause for people to not want to do the work, but want to pay somebody to do the work, taking rational evaluation of the results.
I'll just add an anecdotal story that supports what Charlie just said. I was at a client conference, not BlackRock, where this subject came up, and the question was asked, how many active investors does the market need to keep the market efficient? And one of the participants said that, we've looked at this, and it's actually a very small number. And then he added, unfortunately. So I'm sitting over there, and I raised my hand after the subject had moved on to come back to that speaker, and I said, "Why did you say unfortunately? I have a fiduciary obligation at ExxonMobil to manage these assets for the best interest of my plan participants. If I can do so at extremely low cost, why is that unfortunate?" And he said, "I said unfortunate because it's actually fun managing active money, and we make a lot of money doing it." Wow.
It's honest.
Since I'm the Vanguard guy and I championed active, I'll give the odd answer to this as well, which is I challenge everybody to think about the term active investor and what is included under that. So notwithstanding my previous comments about you can be using index funds, but it's still active management that's going on. For the pendulum to swing so far that we say the world, almost everybody indexes, right? We're now talking not just within funds, but U.S. capital markets. That number of 30% of assets are passive. That's as a percent of ETFs and mutual funds. As a percentage of U.S. stock market capitalization, the number is still only about 15%. But think about this. This means no individual ever holds an individual security, or they replicate everything to be fully market cap weighted. It means no hedge fund exists. It means there's not one human being that thinks they can do better. And my favorite way to take this end game theory as far as it can go is, let's assume prices never move, but companies still make money, right? Stock price is not company performance. And I'm the treasurer at Walmart, I'll just make it up. My stock price never changes, but I keep making money. And every month I watch my PE go from 20 to 18 to 10 to 5 to 2. Do I wake up that day and say, man, my stock is cheap, let's just go to work? Or do I think, maybe we should buy it back? Well, who just became an active investor? I did. So I have fun with that, to take that to sort of the end game theory explanation, but thinking about the term active investor is not as simple as the amount of money that's in active funds versus not active funds. It's a much bigger concept than that.
Let's hear from you. Questions? Yes, sir.
Jim, I heard your interview with Etfs a couple of weeks ago, and I was struck by some of the interesting complexities in actually just managing the broad market index fund. And I was wondering if you could talk a little bit about some of the things that have evolved at Vanguard and that I had never thought about, people wouldn't think about how it's not as simple as just owning a stock and the other things that go into just trying to passively replicate the index.
Say, first of all, thank you for listening to the podcast. I was clearly the side attraction. Jerry O'Reilly, the portfolio manager of Vanguard Total Stock Market Index, was the real headliner, and it was a bit tough when I have to listen to him talk about running a 4 sub-minute mile 7 times, running in the Seoul Olympics, and I said I'm trying to make 1:45.5 marathon upcoming, so I was not nearly as popular. But what gets lost a lot of times, and we had a little bit of a discussion about this at dinner last night about running an index fund. On paper, it seems really easy to say, I get a list of names every day, and I'm just going to make sure that my fund matches that list every day. But every day you have investor cash flow coming in and out of the fund that you might not necessarily have definitive knowledge of the exact dollar amount. So to the extent you have to estimate what the net flow is because you have purchases and redemptions every day. So gauging what might my net duty for that day be. Do I need, if I am uncertain, do I need to find means to equitize or make sure that I am holding down my market exposure till I know my final amounts that I have to buy in the market? Am I dealing with corporate actions that day? Does my list include the proportion of shares in a given stock on any given day is actually more or less because some shares were taken out of the float, somebody was acquired, somebody issued more shares? So even an index on a day-to-day basis can be a moving target. Is that index reconstituting that day? And what I was explaining last night was index funds do not, despite what some may claim, go along as the lackeys when stocks are added or deleted from an index. The manager does not say, well, the whole world has been signaled stock ABC is entering the index, so I'm going to go buy it at inflated prices. That's not what good index fund managers do. They know what those lists are, and they find ways, very skilled ways, to trade ahead of that reconstitution, during that reconstitution, and a little bit after that reconstitution. And it's a very challenging game because obviously on paper, you will be dealing with tracking error if you are not holding those stocks in the index's proportion on that stated day. But you're trying to balance that against transaction costs because the world knows that change is coming. So on paper, running an index fund a lot of ways can seem like a very easy thing. There's my list and I go track it. But there are a lot of moving parts that go on with that even on a daily basis that makes it a very challenging game because indexing is a game of basis points.
Yeah, who am I to follow Vanguard talking about index funds? But we've managed in-house an S&P 500 index fund for as long as Vanguard has had their S&P 500 index fund. And we manage it for well under a single basis point, much less cost than Vanguard would charge you. So everything Jim just said is true. It is not as easy as simply buying stocks and holding them forever. You've got cash flows coming in and out. You've got corporate actions, companies issuing shares, buying back shares, et cetera. So you have to stay on top of it. But it can be managed at extremely low cost, which is my only point.
Yes, sir.
I have a two-part question. One is it's not selecting the index actually an active decision. By the S&P 500, you're ignoring 6, 7, 8,000 other stocks. To be truly indexed, when you need to own everything from Apple and Exxon down to, say, microfinance in some emerging market country. The other part of it is market completeness. If you're indexed, aren't you by definition limited to public investments? There's the private sector. A lot of, I think, the equity risk premium comes from venture capital. I recall back when Apple went public, I did the math. I think Henry Singleton at Teledyne, his cost basis in Apple was 10 cents a share. This is back in 1980. So there was a lot of value realized before it became a public company.
Yeah, so let me just take that first. So we used to, as I mentioned earlier, have buckets like an S&P 500, U.S. small cap, international, et cetera. But in 2009, we put out a competitive bid for a global public equity strategy covering 46 countries, developed and emerging, large cap, mid cap, small cap, the whole thing, other than frontier markets and other than private equity. And so we've gone about as far as we can in the public universe to a single passive product that doesn't have these artificial boundaries built into it as stocks move across those boundaries. So we can, as best we can anyway, have a buy and hold strategy of the whole entire market. We've sort of moved beyond that now to say, but the purpose of the pension portfolio really isn't to hold growth assets in any event. It's to immunize the liability, to serve as collateral against the liability, which has really no equity characteristics in it. It's a long-term bond. So that's why we're migrating more and more towards long-duration, high-quality fixed income that matches the quality of the promise we've made to our employees.
I think you've picked on, you may not have meant to focus quite as specifically as I think you have, so correct me if you like. But if you're involved in wealth management, you know that you have lots of different moving parts. Large homes, boats, jewelry, you have venture investments, you have all kinds of different activities in which the listed securities portion is can be a very small part or can be a very large part. My view is that indexing has a lot of merit to pay attention to that part that you've decided in your macro strategic decision to put into publicly traded securities. Urge you to keep in mind the total portfolio is much more complex and much more important. And I teach a course on investment management at the Yale School of Management. The first class, every student is required to submit one side of one sheet of paper. What was your portfolio mix at age 30, age 50, and age 70, and why? And when you push it, the answer to the why turns out to be, well, that's what the internet said. I did a quick check, and that's what they said. Okay, why 30% at 30, 50% at 50, and 70% at 70? Because that's what they said. Now, you're in a graduate studies program at a major university. You can't just say, well, they told me. You have to explain why. And we gradually tear down that their biggest single asset is not on their balance sheet. It's their future earning power brought back to present value. And they've got the effect of an enormous bond portfolio because they can do a pretty good job of projecting, given the field they're going to go into, what kind of income they're going to have. Get them to start thinking in a very different way. So if you're involved in wealth management, I'm sure your principal thinking is strategic portfolio structure, not the implementation. And we're just looking at a very, very narrow question, which is the implementation of a securities portfolio.
Yes, sir.
Just a question. You mentioned smoking, Vegas. People do things that they shouldn't do necessarily. And we were just talking when we sat down about in order to be really, truly a passive investor, you have to be passive. You know, you might have to put it in and not touch it. And yet people, it's been proven, and you know, J.P. Morgan's shown charts, Peter Lynch used to show charts, that the average passive mutual fund has a certain return, but the actual investors make a different return, and it's almost always lower. And because you're buying high and selling low. So can you kind of comment on that? So there's this theoretical idea that passive investing is the right way, or could be a good, tool for somebody. But how do you protect people against themselves?
We're pretty soon going to get into an NRA discussion about rifles.
Let's not.
It's a big difference between persistence and passive. Passive is, oh, hell, I don't know anything about this stuff, so I'm just going to sit around and look dumb. I think there's a really good case to be made for pay close attention to what are you doing, but focus on what are you doing at a policy or strategy level where frequent decisions are simply not required and not expected. But that doesn't mean you shouldn't be checking on a regular basis. So I would be active in terms of being on the alert for a force of change that I would want to pay attention to. Some of it could be personal. As you get older, that's a force of change you want to pay some response to. If you happen to shoot the moon and become exceedingly wealthy, that's something you want to pay attention to. If you have individuals in your family that are in serious difficulty and they're dependent on you, that's something you want to pay attention to. So there are a lot of different variables that might come up from time to time, and you should, no reason to do only once a decade look or once a year look. It's worthwhile being on the alert in a general way, but there's no need for action. And it is a shame that people do get caught feeling they ought to do something. Jason Zweig is a friend of mine, and he said, one day we're talking, he got me to admit that I'd had one investment in Berkshire Hathaway since the early 1970s, and I do check the price every chance I get. And he said, that's absolutely ridiculous. And I said, I know it is, but at least it's in confined limits. And doesn't cause my parents any anxiety, doesn't cause my grandchildren any anxiety. It's my silly little quirk.
I just add, it's probably one of the reasons I'm such a strong advocate for a defined benefit system. I don't believe the level of financial literacy is very high anywhere in the world, with the vast majority of people who are trying to save for their own retirement. Is an incredibly challenging problem even for Nobel laureates. In a defined benefit plan, you take all of that away from the employee. And defined benefit plans were very successful for many decades at providing predictable, quality retirement income. And you have to ask yourself, why? Why were they so successful when the only investment the plan participant owns in a defined benefit plan is a long-term fixed-rate annuity, a low-returning asset. No growth assets at all in a defined benefit plan. So how did they get to such an attractive retirement income with such a low-returning, safe asset? And the answer is a very high level of forced savings. And you take away from the employee all the choices to, as you say, trade and have suboptimal performance. Because they really aren't skilled enough to make those decisions over time, over long periods of time. So it's one of the reasons I really do like the defined benefit system. High level of forced savings, safe investment, predictable outcomes, no financial literacy required.
It also Let me give you a quick metric of how much of an ignorance we live with. If you ask virtually anybody, knows that Social Security you can claim it at 62, and you can wait till you're 70.5 to claim it, and anywhere along that spectrum you can claim. What is the delta of what you will get from Social Security every year if you wait from 62 until 70.5? Most people will say, ooh, it must be a lot. Certainly more than 20%. I wouldn't be surprised if it would be 30, maybe even 35%. The actual number is 76%. And those of you who knew that and say, oh, yeah, hell, I've known that, ask the next 5 people you see after this meeting what they think the delta is. Protected against inflation, and it goes for as long as you live. 76% is a huge change in the life experience of people in retirement, and it should be the single best-known number in this country. And most people have no idea what the real number is.
Yes, sir, in the back.
Colin, you talked a little bit about, or you talked a lot about kind of the passive risk assets. then touched on the end on kind of what I think of as the ultimate passive investment, which is LDI.
Yeah.
Maybe talk a little bit about how your plan thinks about the split between the two over time.
Sure. When I came into the position, we had a portfolio around the world that was approximately 75% in equity investments, diversified equity investments, both public and private, and 25% in sort of intermediate duration fixed income. So not well matched against the character of our liabilities at all. In my tenure, we've been able to switch the global portfolios now to an asset allocation of only 40% global equity, 60% fixed income, all matched in duration to the underlying liabilities. But we're not done. We are gradually migrating to higher and higher levels of fixed income and taking down the equity as we go, with a very long-term vision that the right economic answer for both our plan participants and our shareholders is to have essentially an immunized portfolio. How we can afford defined benefit plans if we're not earning a high level of return with the pension assets is simple. It's the productive services of our labor. A defined benefit is simply part of total compensation. We don't need to go out and take financial risk in Coca-Cola and United Parcel Service to pay the cash salaries we pay our employees. We don't need to do the same thing to pay the deferred compensation we pay our employees through a defined benefit plan. It's the productive services and the profitability of ExxonMobil that allows us to pay this type of benefit. And so we'll simply make higher cash contributions to these plans. We understand the cost of the defined benefit plan, and we factor it into the total compensation discussion. Sir.
Colin, you mentioned you're a big fan of defined benefit plans. So obviously our state pensions here in the States are also defined benefit large. And yet we've got some challenges here. So on average they're 75% funded. There's an expected rate of return of about 7.6%, 75% growth assets as opposed to your balance fund. How do you think that's going to play out?
Not well. And they're not 75% funded. They're probably 40 or less % funded because the actuaries allow them to discount the liabilities at their assumed asset earnings rate, which is up around 7.5% or 8%. And the reason they have a lot of risk assets is so they can sustain such an assumed rate, to pretend that the liability is worth less than it really is, so they don't have to collect as many taxes to fund the true cost of the services that are being delivered. We're simply shifting the bill to future generations. I believe it's immoral.
John.
One of those questions that a little bit like the 76% delta. How many of you know how much your state has in the way of pension obligations that are going at some point to be court of law and readjusted perhaps, but at some point are supposed to be paid? Those of you who live in Connecticut, it's worth double checking because it's a very large number. Yes. And if you look at the components on the assumptions of return and the actual experiences of return, you'd say it was an even larger number, just as Colin was saying. It's a major item.
Yeah, and the Society of Actuaries, the American Academy of Actuaries, I don't know if you've been reading in The Economist and the Wall Street Journal and other publications over the last several months, have had a bit of a brouhaha over this issue. They had a joint task force that was working on the issue of applying financial economics to the valuation of public defined benefit liabilities. The task force draft paper concluded that the right way to discount those liabilities was essentially using a risk-free rate, because these promises are backed by the tax-paying, the taxing authority of the jurisdictions that are issuing these obligations, much like a municipal bond. The initial reaction of the two organizations was to shut down the task force and not allow the paper to be published. The SOA has reversed its position and has now published the paper, but that was, I think, very telling.
John.
Colin, do you have an investment committee, and if so, what do they do? The second question is, if you don't have one, would you like one?
I love that question. No, it varies around the world. Obviously, we have defined benefit plans in different places around the world for our various affiliates, and we always operate within the law, and so the local regulations and laws from country to country vary on what one must do to properly manage and govern these pension trusts. In the U.S., we have a single named fiduciary, a single person, no investment committee. In the UK, we have a board of trustees represented by both employee-nominated individuals and employer-nominated individuals, all working for the company. So it really ranges the gamut from a full board of trustees. In the Netherlands, we have a board of trustees and an investment committee that helps the board of trustees think about these things. But the way we're set up, my group is a center of expertise in the global headquarters for benefits finance. So rather than ask these investment committees and trustees and single name fiduciaries to work with an outside consultant or maybe several outside consultants and get disparate advice, we ask them to work with our internal center of expertise, my group, so we have very consistent application of investment advice around the world that takes into account how the plan sponsor is thinking about these liabilities. And it works very well for us.
Sir.
I wonder what percentage of the people working currently are parts of have a pension plan?
Say that again, sorry?
What percentage of the working population participates in a pension plan or working with a company that offers a pension plan?
So you mean beyond ExxonMobil?
Yes.
There's about...
The other way in the last 30 years.
No, that's correct. In the S&P 500 companies, there's about 20% only that still have an open defined benefit plan for new hires. And of that 20%, only roughly a quarter still offer a final salary defined benefit plan. Others have shifted to what's known as a career average plan, which is basically just a different accrual rate for the benefit over one's career. It's generally a lower cost plan. So 5% of the S&P 500 roughly still have an open final salary defined benefit plan.
On the S&P, it's probably lower.
Yeah. So I'm fighting an uphill battle, but it's a battle worth fighting.
Great.
Yeah, Charlie, I might as well ask this specific question, given your involvement with Yale. Is there a construction, an index construction, that you could put together that would have outperformed Yale and Allen over some extended period of time? I'm sure you can ask that.
No. Let's be really clear. If you're Jim Simon and you've got his capabilities, you should be an active investor his way. If you are David Swenson and you've got 30 years of building an unbelievable scuttlebutt network of exceedingly talented individuals who understand you're very disciplined in what you do, you should continue doing it. If you expect to get much in the way of an incremental rate of return, you're not David Swenson. He expects to get a modest amount of incremental return after adjusting for risk. The big question would be, if Yale no longer had the benefit of David's wonderful services, go 10, 20 years out, and he had retired, would you recommend that Yale use active strategy and follow the quote-unquote Yale model? The answer there is candidly no, because I think it's partly the scale allows. Yale's endowment is less than $30 billion, so it's not a very gigantic amount of money. They have over 150 different investment managers, very carefully selected, very tight working relationship, unbelievably hard to remember who those firms are because most of them are unfamiliar names to almost all of us. It's a very specialized kind of an operation. And I do believe that there are individuals and there are organizations that have found a way to design their investment operations such that they should not convert to indexing at this time. It does also mean to me that the tide is rising, the skill set, the tools equivalent. Everybody has the same equipment, everybody has the same resources of people, everybody is getting closer and closer to being identical in what they're doing and the skills with which they do it. And every day you're buying and selling to and from people equally talented. It gets harder and harder to do better. At some point, everybody says, rationally, it doesn't make any sense for me to continue playing. But there will still be, at the strong end of the long term, there'll still be a small number of individuals able to do something really terrific that is unique in the way they do it, and it's not inside the normal flow, and they're really not competing with everybody else. And I would think they ought to continue doing it. What I believe most deeply is that if you accept that you don't have to bother about the operations, you're then free to do the really important questions. And I would love to see more of us spend more of our time working on the really important questions. What should be your portfolio structure? And if we would get that right more frequently as a society, as institutions, we'd do a lot better.
Sir.
You guys mentioned smart beta, and you just touched on it quickly, and I was curious what your thoughts on institutions looking at or investing in for smart or alternative beta products and trying to capture empirically observed risk premium that, on a long-short basis may provide an uncorrelated return stream to some traditional assets.
I've got the high-risk position of when you walk out of this room and pick up this little book with the three guys on the cover, The Spirit of 76. In the back it says what I really believe about smart beta. I wish the hell I'd been in Scotland when those two guys got together and said, Ian, we're going to change the name. Angus, why do you want to change the name? It's a good product. Ian, it's not selling. Well, it will. Be patient. No, Ian, we got to do something about the name. Let's stop calling it death insurance and call it life insurance instead. Smart beta has got to be the best naming since then, or maybe even better. It is terrific. If you are a gifted analyst of factors and you've got really good quantitative skills and you've got a lot of discipline in how to think about factor investing, I believe, and I believe the record shows, you can be very successful with factor investing. But if you're a normal investor, the time that you're going to get interested in any one factor is going to be when the proof is best because it's been really working, i.e., it's almost over. So you're going to collect more of the downside and less of the upside than those who are skilled. And you will take it as your fault, your mistake, you should have done better. Next time, you're going to be more careful. And I believe it's going to sell for a long, long time. But I also believe it's going to take not giant amounts, so nobody will really complain all that much. Gradually just peel off, take a little bit, take a little bit, take a little bit away from the investors who get into what they will cheerfully call smart beta. And I think it's a dumb move on their part. But, people are people. If you haven't studied enough behavioral economics to realize people do all kinds of the darndest things, and they're going to keep doing it, me included. I mean, I was on the I-95 last night, and you all know that I-95 this time of year, that time of day, tends to have terrific traffic jams because that's when they do the road work. Well, okay, I missed dinner. That's the worst that happened. Had missed the chance to have a nice conversation with some really bright guys. That's not all that painful. I'll probably get caught on 995 again.
I'd encourage, when we think about the phrase smart beta, to realize that smart beta is a form of factor investing. Factor investing is not a form of smart beta. What Charlie just talked about, all the comments hold with factor-based investing. Smart beta works a little bit differently. Rather than bring a explicit strategy piggybacking off factors, whether or not you believe in the factors or not, smart beta strategies have other security selection processes, mechanisms that implicitly produce some form of factor exposure. And it's not always a consistent factor exposure. So for investors who may believe in the value premium or the small cap premium, that's one thing to pick a fund that holds itself out as a factor-based fund, right, for the explicit reason of capturing one of those academically discussed factors. That is different from somebody who labels their fund as smart beta and says, we pick funds based upon sales ratios and dividends and other metrics that over some time period may produce some amounts of value, maybe more or less, some amounts of small, maybe more or less. So the difference with that lies not only is the performance of smart beta all explained by factor exposures, but it's not built in a way to explicitly give you a factor exposure that you may wish to target.
Well said.
We've reached the end of our time. I want to thank Jim, Colin, Charlie for your insights. Excellent program. Steve and Connie, thank you very much for making this possible in the Greenwich Roundtable. We're delighted that copies of Charlie's book will be available to you on your way out. And of course, thank you all for sharing part of your morning with us. It's been a great discussion.